One missed grace period deadline just cost an investor $340,000 in lost exchange time, not in actual penalties, in lost opportunity. And it happens more than you'd think in real estate investing. Welcome back to Brick and Dollar Research. I'm your host, and this week we're breaking down grace period mistakes that are silently draining investor portfolios across the country. These aren't theoretical problems. Research shows that property managers and individual investors lose an estimated $2.3 billion annually to grace period-related penalties and missed deadlines in the residential real estate market alone. So what exactly is a grace period, and why does it matter so much? A grace period is the window, usually measured in days, where you can miss a payment deadline without triggering penalties or default notices. The problem is that most investors fundamentally misunderstand what grace periods actually protect, and more importantly, what they don't. Let's start with mortgages, since that's where most investors interact with grace periods first. Mortgage grace periods. The first trap according to Federal Reserve lending data from Q3 2024. The typical residential mortgage grace period in the United States is 15 days past the due date. That sounds generous, right? It's not. Here's where investors get blindsided. That grace period applies only to late payment penalties. It does not stop interest from accruing. It does not prevent the lender from reporting the late payment to credit bureaus after 30 days. And it absolutely does not stop the foreclosure clock from ticking in many states. Data from HUD's mortgage performance reports indicates that approximately 18% of investment property mortgages are processed with non-standard grace periods. Some lenders, particularly hard money lenders and portfolio lenders, offer 5-day grace periods. Others offer 20 days. The variance matters enormously when you're managing a portfolio with 8, 15, or 25 rental properties. Imagine this scenario. You're managing 12 rental properties across 3 states. You have mortgage payments due on the 1st of each month. Rent collections are always variable. Some tenants pay on time, others pay mid-month. You're relying on the 15-day grace period to buffer against that volatility. That's mistake number 1, because on day 16 your lender isn't just charging you a late fee. They are reporting that 16-day delinquency to the credit bureaus. That stays on your credit report for 7 years. Data indicates that a single 30-day late payment can drop your credit score by 100-150 points. For an investor with a 750 credit score, that single grace period miscalculation pushes you down to 600-650 territory. Now your next refinance costs you not $8,000 more in interest. It costs you $23,000 more because your rate just jumped from 5.8% to 7.2%. On a $280,000 portfolio mortgage, that's $3,200 per year in additional interest costs compounded over 15 years. The grace period didn't protect you, it just delayed the consequences. Research from the Mortgage Bankers Association shows that most investment property mortgages carry prepayment penalties during the first 3-5 years. Those prepayment penalties exist precisely because lenders know that investors who understand their mortgages will refinance the moment rates drop. But investors who don't understand grace periods and who are managing late payment cycles are locked into paying those penalties even when refinancing would save them money. Here's the data that matters. According to 2024 lending surveys, investors with investment property portfolios currently carry an average mortgage rate of 6.4%, while the conforming conventional rate is hovering around 5.9%. That 50 basis point spread on a $350,000 loan is $1,750 per year in preventable interest costs, but you can't refinance if you're constantly in grace periods. Property tax grace periods. The financial disaster ***. Now let's move to property taxes, and this is where the research gets really alarming. Most investors assume that property tax grace periods work like mortgage grace periods. They don't. According to the Tax Foundation's 2024 research on property tax administration, approximately 31 states offer property tax grace periods before penalties accrue. But here's the critical distinction. Those grace periods apply to the liability itself, not to your payment obligation. You still owe the tax. The grace period just delays the penalty. The penalties are severe. Research from state tax authority data shows that property tax late penalties range from 5% to 10% per month in most states, with some states charging compound penalties. Imagine you own a property in California worth $580,000, roughly the median home price for investment properties in the state per 2024 data. Your annual property tax bill is approximately $6,960 per year. If you miss the grace period by 30 days, you're looking at penalties of $348 to $696 on that single property. But here's where it becomes catastrophic. If you own that same property in a state like Illinois or Texas, the penalties are applied differently. Some states charge penalties on the original tax amount, others apply penalties to the tax plus accrued interest. Texas data shows that delinquent property taxes can result in a tax certificate sale, where the county literally sells your property at auction to satisfy the tax debt. This isn't theoretical. County tax assessor data from Dallas, Houston, and Austin shows approximately 4,200 properties sold annually for tax delinquency. The grace period was supposed to protect you. Instead, it gave you a false sense of security, while the penalty clock ticked silently in the background. Data from the National Association of County Assessors indicates that investment properties, residential rentals, commercial account for approximately 34% of all property tax delinquencies. Why? Because landlords are managing multiple properties across multiple jurisdictions, and grace period deadlines vary by county. What's a 30-day grace period in one county might be a 10-day grace period in the county next door. *** 1031 exchange grace periods. The $340,000 mistake ***. This is where our opening example becomes real. According to IRS publication 1031, the rules for 1031 exchanges are absolute. There are two critical deadlines, the 45-day identification period and the 180-day closing period. These are not grace periods. They are hard stops, no extensions, no exceptions. The IRS allows you to identify replacement properties within 45 days of closing your exchange property. You have 180 days from closing to actually purchase those replacement properties. But here's where investors get confused. They think the grace periods in their mortgage or escrow documents somehow apply to 1031 timelines. They don't. Case study: an investor in Colorado sells a commercial property valued at $850,000 on March 15, 2024. The 45-day identification deadline is April 29th. The investor's escrow officer tells him, "Don't worry, we have 10 business days after closing for the paperwork to settle." The investor assumes that settlement delay gives him extra time for identification. It doesn't. The IRS clock starts on March 15th. April 29th arrives and the investor still hasn't formally identified replacement properties. The exchange is disqualified. The investor owes capital gains tax on $340,000 of profit, plus 20% federal tax plus state tax. That's approximately $97,000 in taxes that could have been deferred. Data from the Federation of Exchange Accommodators shows that approximately 8% of 1031 exchanges fail due to timing violations. That represents roughly 12,000 failed exchanges annually. And the vast majority, research suggests 73%, fail because the investor relied on an assumed grace period or deadline extension that simply doesn't exist in the IRS code. The 1031 exchange rules are published in IRS publication 1031. The grace period does not exist. 0 days, no buffer. HOA fees and CAP rate compression for investors holding properties in planned communities or commercial properties with HOA obligations. Grace periods create a different problem: cap rate compression. According to 2024 data from the Community Associations Institute, the median HOA fee for residential properties is $312 per month. For luxury properties, HOA fees can exceed $200 per month. For commercial properties with HOA or mandatory membership fees, we're looking at $500 per month depending on the asset class. Grace periods on HOA fees typically run 15-30 days before penalties are assessed. But here's the research that matters. HOA delinquencies can trigger liens, and HOA liens have priority in many states. That means if your tenant hasn't paid rent, or if you're in a cash flow crunch and your HOA fee goes unpaid, the HOA can literally foreclose on your property before your mortgage lender can. Data from the Community Associations Institute indicates that approximately 15% of all HOA liens result in property sales. An investor holding a property with a $4,200 annual HOA fee that experiences a single month-long grace period breach is looking at penalty fees of $420 to $840, depending on their HOA bylaws. Over a 10-property portfolio, that's $4,200 to $8,400 annually in preventable penalties. But the real damage is to your cap rate. Cap rates for residential investment properties currently range from 2% to 8% depending on location and property condition per 2024 market data. If you're managing properties with a 2% cap rate and late fees and HOA penalties are consuming $6,000 to $12,000 annually, you've just compressed your cap rate by 0.5% to 2%. On a $200,000 property, that's the difference between a profitable asset and a marginally performing liability. State-by-state grace period variations. Here's where it gets complicated. Grace periods are not federal, they are state and local. According to State Housing Authority data from 2024, California's grace period for residential mortgages is 15 days. Texas's grace period is also 15 days, but Texas property tax grace periods differ radically by county. New York State mandates a 31-day grace period before lenders can report delinquency. Florida offers a 15-day grace period on mortgages, but has strict late fee caps at 5% of the monthly payment. An investor managing properties in California, Texas, and Florida simultaneously is managing 3 different grace period regimes. Miss the deadline by 1 day in California, and you're reported to credit bureaus. Miss the deadline by 1 day in New York, and you're within the legal grace period. This variability explains why approximately 23,000 real estate investors file for bankruptcy annually, according to American Bankruptcy Institute data. A significant percentage cite grace period miscalculations and cascading late fees as a primary factor. How to protect your portfolio. The research is clear. Grace periods are not your friend. They're not safety nets. They're deadlines with a 15-30-day delay before penalties accrue. Here's what the data tells us about successful investors. They don't rely on grace periods. They don't use them as a planning tool. Instead, they treat the due date as the actual deadline and build 10-day buffers into their payment systems. They use automated payment platforms where possible. They track grace periods by property and jurisdiction, and they maintain a separate cash reserve specifically for property-related obligations, separate from operating reserves. For investors managing 1,031 exchanges, the data is unambiguous. Hire a qualified intermediary, document the 45-day and 180-day deadlines in writing, and mark those dates in 3 different calendar systems. There is no grace period. The research on successful real estate portfolios shows that investors who eliminate grace period reliance see an average improvement in cash-on-cash returns of 0.8%